Hello and welcome to the video. My name is Brandon, and today I'll be talking about everything that you need to know about asset allocation. So when you want to invest and you want to do it properly, you don't just pick 5 random stocks, hope for the best, and call yourself an investor. I mean, I'm sure there are people out there that are doing that, but as with anything in life, if you want to succeed, you have to set a goal or a plan or a strategy and then execute that plan. And that's exactly what your asset allocation sets out to do. Your asset allocation is the literal guidelines or targets as to how your money will be invested. So if you had X amount of money, whether that's $100, $1,000, $10,000, or $1 million, your asset allocation would tell you, well, how much of that money is being directed to each asset class. Now, what are the asset classes available to us as investors? Well, the 3 common ones would be equities, so stocks, fixed income, so bonds, and then cash and cash equivalents. And some people like to include a category for other, maybe real estate or commodities or like a speculative, but let's just leave it at the common 3. That's pretty standard. Now to quickly recap on these 3 asset classes, we have equity. And this would be the portion of your portfolio responsible for the growth. When we invest in stocks, over the long term, we'd expect higher returns, but with that would come a higher level of volatility. And for lack of a better term, we can call this the aggressive part of our portfolios. And that's not to say that every stock is aggressive. I mean, you can have aggressive stocks, you can have conservative stocks, you can have stocks right in the middle. But in comparison to the other asset classes, yeah, this would be the more aggressive growth-oriented aspect of our portfolios. And then you have fixed income. So this is where we're lending out our money and we're receiving an interest rate in return. So like bonds. And this would absolutely be the more secure, conservative component of our portfolios. When we invest in bonds, we're not expecting a whole lot of growth from these assets, but they do serve as the defensive part of our portfolios. And lastly, we have cash and cash equivalents. And this would be literally cash that you have in your portfolio or assets that are highly liquid. And by liquid, no, I don't mean watery. Liquid meaning that it can be exchanged for cash very quickly. And with this section of our portfolio, we would literally expect, little to no growth, but it would be highly accessible for us. And you'll always have some cash in your portfolio, whether it's there on purpose or whether it's from dividends flowing in or maybe some interest from your bonds. And before I get into what the best asset allocation is for you, let me go over the benefits of having a good asset allocation. And there's 2 primary ones that I'm going to talk about. Number 1, diversification. And we've all heard the term, don't put your eggs in one basket. Because if something happens to that basket...
What are you doing? What is this?
And when it comes to investing, this is bar none one of the most important principles or concepts that we have to follow. And this is why you would never want to invest all of your money into a single company or a single stock or even a specific sector. Because no matter how good the company is, that's just far too much concentrated risk in one area. And I'll give you a little basketball analogy because I love basketball. Now you can take one of the top players in the world, like Steph Curry, and 90% of the time, he's gonna perform like an all-star. I mean, he is a great individual player, super talented, he's very, very good at what he does. But there are areas of his game that aren't the greatest. And even the best players, they miss shots, they have bad games, and they go through slumps. So if you had a team that was built up of 5 Steph Currys, well, at times that'd be pretty freaking awesome. I mean, that'd be pretty outstanding in certain aspects, but you'd also be lacking some very essential components to a good, well-rounded team, like rebounding and defense. So a better approach would be to look at it from a holistic view. And like you could say you'd have your offensive players, right? Like Steph, Durant, and Clay. These could be like your stocks. And then maybe you'd have some defensive players like Draymond and
JaVale McGee. He's a regular on Shaq.
And these could be like your bonds or the defensive aspect to your team. And as a whole, your team would be better off. There'd be less vulnerabilities. Exact same with a portfolio. You want to make sure you're diversified amongst the asset classes and amongst all the different sectors in the economy. And that way, as the economy grows as a whole, you partake in those gains. And when a single sector or a single stock gets slammed, well, you're not overexposed to it. And if you think it's easy to predict how the market or the economy will react, we first need to understand there are a lot of moving parts to an economy. I mean, the different asset classes, the different stocks, the different industries, everything's going through their cycles. And they all react differently to different economic conditions. And over the short term, it can be very difficult to predict what will happen. But over the long term, they tend to balance each other out and they appreciate and they grow. And to emphasize my point, let's take a look at this table or chart. And it shows us the performance of the different asset classes over the past 20 years. And it ranks them from the worst performing asset class at the bottom to the best performing asset class at the top. And it's all over the place, right? I mean, for example, let's take a look at 1998 and 1999. The top performers are the big, large cap growth stocks. Well, a year later, they're the worst performing asset class of them all. Or we can look at, let's say, international equities. In the early 2000s, very terrible performance, down 14%, down 21%. Then over the next number of years, it's a fantastic place to invest your money. Or bonds. Worst performers in the majority of the 2000s, then in 08, well, they're the best performing asset class. Then 2009, they're back down at the bottom, and then back up at the top in 2011. So very difficult to predict. And if you have a crystal ball, and you can guess what's to come in these next coming years, well, good on ya. But the best approach to take when investing to mitigate your risk is to spread that risk amongst the different asset classes, amongst the different sectors, diversify. And that's actually exactly what this orange one is right here. It's a balanced, diversified portfolio. And year in and year out, very consistent, very predictable returns. Now, the second benefit to having an asset allocation, it enforces discipline. And when you have targets set and your portfolio deviates away from these targets, you have a guideline as to how to get it back on track. It's like resetting your portfolio. And if you're dedicated to keeping your portfolio balanced to its asset allocation, it really helps with stripping the emotion out of investing. Take, for example, in a bull market, when equities are performing very, very well. It's easy to get greedy, let the stocks run, maybe try to inch out some additional returns, but you're inherently exposing yourself to more risk as the equity portion of your portfolio gets bigger and bigger and bigger. Logically, one of the best things that you can do in a time like this is to trim back and take some profits and reinvest that back in some areas of your portfolio that maybe aren't doing so hot. And if you truly believe that the economy goes through its cycles, which it does, well, an asset that's been performing very, very well over the past little while, maybe there's more downside potential than there is up. Or for a stock or an asset that isn't doing so well, maybe some investors are going to start seeing some value there, which would drive up the price. So you can tell yourself, if my portfolio deviates like 5 or 10% away from our stated targets, well, I'll rebalance back to my asset allocation, get myself back on track. So very good with the discipline and a big benefit to having an asset allocation. So what is the best asset allocation for you, and how do we go about determining your asset allocation? Well, traditionally, investors use what's called the age method, and it's proven to be quite accurate and quite reliable. How it works is that you take the number 100, you subtract your age, and that number you get, that's your target for what your equity weighting should be. So assuming that you're 20 years old, you take the number 100, subtract 20, and you get 80. Meaning that if you had $10,000 to invest, $8,000 would be invested in stocks, $2,000 would be invested in bonds. And the good thing about the age method is that as you get older and you tend to get a little more conservative, your weighting to equities would gradually decrease. For example, now you're 40 years old. Well, your split would be 100 minus 40, a 60-40 portfolio. Still great exposure to stocks and a healthy dose of bonds. And this would be a perfectly balanced portfolio for someone around that age. And if we were to bring up a matrix here of the different asset allocations, these are some of the properties that we'd expect. A portfolio that's fixed income dominant would absolutely be the most conservative. Very low volatility, right, when the portfolio is only made up of bonds, but of course your expected return would be very low as well. And as you increase the weighting to equities, you'd expect to see higher and higher returns. But with that would come an increase in volatility. Now for a younger investor, for a millennial, we would absolutely fall towards the higher end of the scale. Of course, you need to factor in things like your investment objectives, your risk tolerance, and your time horizon. But in general, a younger investor should absolutely be concerned with growing their wealth, accumulating assets, and ultimately striving for higher returns. So what is the best asset allocation mix for a millennial? Well, I like to go for an 80-20 split. That's how my portfolio is built. That's how my clients' portfolios are built. And when you take everything into account, I think this is a perfect balance for a younger investor. It absolutely is an equity-dominant portfolio, but that's how it should be. Again, our primary concern should be growth of capital or capital gains. And that's exactly what stocks set out to do. But it does give you decent bond exposure as well. And like I said in my last video, I stand firmly behind the fact that bonds are an essential part of a portfolio. Not only for the income that they provide, but the fact that they act as a hedge or a buffer in a down market. And to build off that point, for a millennial, I wouldn't recommend going any lower than a 60-40 split. As millennials, we need to take advantage of this opportunity that's presented to us. We're at a point in life with very few expenses and an extremely long time horizon, and our portfolios should reflect that. Being too conservative at this age, not the best choice. So ultimately, go with an 80-20 split. 80% invested in equities, 20% invested in fixed income. And to finish this video off, what investors would commonly do is they take it a step further and they break down their equity component, maybe to, let's say, half US equities and half Canadian equities. Or you could take it a step further and say, hey, maybe 30% in Canadian equities, 30% in US equities, and then have some exposure to the international markets or the emerging markets. That way you'd be truly diversified amongst the markets. You can even split your bond component between governments or corporate or even high yield. Again, just spreading your eggs amongst different baskets. And that's my video on asset allocation. It's one of the first big decisions that you have to make as an investor. And I'd recommend doing some additional research online. I mean, there's tons of places where you can go read up about asset allocation. It's a very popular topic. I'd look around and go check out some other investors, see what they're doing, then make a decision for myself. Because setting yourself up with a good asset allocation that's applicable to you is going to be one of the main factors in how you do over the long term. And you'll hear the term in investing called set it and forget it. And if you can set yourself up with a good asset allocation that's relevant to your goals and needs and just kind of leave it, you'll often outperform an investor who's constantly adjusting their portfolio and trying to play the market, or what we would call active management. So if you enjoyed my video, give it a thumbs up and subscribe for more content. And I thank you for watching, and I'll see you in the next video.